Hello everyone, this is Kishore. Welcome back to my channel. Today I'd like to go over major market index analysis, US futures, futures open interchange, dark pools and COT data analysis, crude oil price and opportunity, US dollar index at critical point, employment data and jobs data analysis. Is August Beige book giving first warning signs? Where are we in business cycle? This is not a financial advice, just for knowledge purpose only. Let's jump into the show. CNN Fear Grade Index, this week it is in the fear. We know that last week it is in the grade. As market fell down a lot, market sentiment changed from the greed to the fear. And the sector performance, left side is the Friday sector performance. All sectors are red except real estate. And for the week, all sectors are red except real estate and consumer staples. And COT data, so Nasdaq and Russell are having bearish index, and also the big switches also bearish. So this is good for the bulls. And crude oil is bullish 100%, so which is good for the longs. And this is US futures for September contract. I shared this chart 2 weeks back. There is a huge liquidity at 5250. So whenever there is a huge liquidity, market tends to go that side. So let's see whether it goes to 5250 by September 20th. And this is open interest change for the ES, NQ and RTY. Based on the open interest change, ES is having support at 5325 and resistance at 5450. And for the NQ, 18,000 is having a good support level, and for the RTY 2000 is support, and upside there are a lot of open interest change for the calls up to 2170. And this is dark pools for the SPY. There are not much dark pools for the SPY at this current price, and also for the QQQ there are not much dark pools for the QQQ at this level. And these are late sell dark pools, means they came yesterday, on Thursday it came, but they are reported on the Friday. And this is dark pool data for IWM. There is a huge dark pool came at to the 207 level, which is like 153 million on Friday. And this is USD JPY weekly chart. So on August 5th, there, because of the Japan and carry trade issue, it dumped it to the 141 level. And right now, where we are very close to that level, let's see if it breaks here, what happens. And this is crude oil weekly chart. Right now, it's very good support level 68, and if it breaks here, then it goes to the 62. Right now, MACD is going down, RS is going down, chart is bearish, but crude oil futures are bullish. So there may be a chance it can bounce very close to the 68 or the 62 levels. And this is 10 and 2-year treasury yield spread. So this is the longest yield inverted time compared to any time in the history. So let's see how it impacts the stock market and the bond market. And this September market performance, the dotted lines are the seasonal pattern from 1950 to 2020, and the thick lines are the current market. So based on this chart, the first few days market goes down and then goes sideways, and then again the last 10 days it may go down. But looks like it's initially it started itself with the market is going down. So let's see whether the seasonality pattern is followed with the market or not in next couple of weeks. And this is percentage of stocks about 20-day moving are in the SPY. Whenever it hit 85, that's a selling point for me, and whenever it comes to 14 or 15, it's a buying opportunity. So it happens every September, October, and March based on the last couple of years. And this SPY daily chart, so very good support level at 531, 0.618 Fibonacci level, and also it's a previous support and resistance level. And it's 536 is the 100-day moving average. So if it 536 breaks, then 531 is the next support. If it breaks, then 511 is the highly possible chance. And the SPY weekly chart, so very huge bearish engulfing candle with a huge volume, and MACD is going down and RSI is going down. So it's the right now the SPY looks very bearish. And this is QQQ daily chart. So Fibonacci level of 0.618 level right now, 447 and above, and it's a 20-day moving average at 441. If it breaks 447, the next support is 441, and then if it breaks, then 423 is the next support. And this is QQQ weekly chart based on the Fibonacci level. If it breaks 445, then 408 is highly possible because the money is moving out of the technology sector based on the charts. Let's see. And this is IWM daily chart. Right now, it's very good support level of Fibonacci level 0.618, 206, and also this is the 100-day moving average. And also there is a good dark pool at 207. So if it bounces, then it's good for the IWM long. Otherwise, it can come back to the 196 level. And this is the IWM weekly chart. 50-day moving average, it's very close to the 197, and that is also previous support level. So if it breaks 207, then 197 is the next support level. And this is TLT 20-year treasury bond. It's a weekly chart. It's made a cup and handle kind of pattern. The measured move is the 112, and it's a MACD is going up and RSI is going up. So chart setup is bullish and the target is 112. And this is Bloomberg US Aggregate Bond Index. So compared to the history, this is the longest number of months bonds are going down, and so with a huge drawdown at 17.2%. And this is after the first Fed cut, value led growth for 6 months, small led growth for 3 months, 6 months, and 12 months, and also bond led stocks. So based on this one, and also the chart setup, bonds are good for longs. And also the DXY, the US dollar index. So right, it's very good support level 101. If it breaks that 99, but it breaks here, then it's going to lock down. But dollar performs well in September. Based on the seasonality pattern, September is very, very good for the dollar. If it bounces here, that's a good for the dollar. And I would like to share this one in X. Financial News shared this data. Japan, on 9 September 2nd, Japan's foreign minister, I want to declare the end of deflation as soon as possible. And on 9/4, Japanese bonds actual 1398.5 billion, forecasted is 859. Previous is 859 billion. So from the previous to the now, so huge jump. So that's a good for the Japan bonds, because as they're increasing the interest rates, so bonds are getting demand. And here, Bank of Japan to supply US dollar funds against pooled collateral starting September 5th. So I'm not sure how it is going to impact the stock market, but looks very interesting to me. That's why I'm sharing here. And this is next week economic calendar. Wednesday and Thursday are very, very important. Wednesday CPI data is coming. Thursday PPI data is coming. I do not have the data, but dry Baltic index is going up. That's not good for the PPI. And this is last week economic data we got on Tuesday. Construction spending, it came worse than the expected one. And on Wednesday we got job openings, Fed Biz book. I'll share one slide on that one. On Thursday we got ADP employment, initial jobless claims. And Friday we got US employment rate and report. So based on from the this is from the beige book. So out of 9 out of 12 Federal Reserve regional districts reported flat or declining economic activity in August. So out of 12, 9 members they said their economic activity is flat or declining, which is not a good sign. And this is up from the five, means on July report only 5 districts are there, now nine. So these are the added in this current in August report: Philadelphia, Richmond, Atlanta, and St. Louis. And also they are saying that even though the layoffs are not there, firms are reducing the workers shifts and hours. So they are reducing their cost by reducing the number of workers hours and also the shifts. Manufacturing activity dropped in most districts. Residential construction and real estate activity were mixed, with most districts reporting softer home sales. We saw that number of home sales or existing home sales are down, and also we saw that affordability home index is going down. So this report is very, very similar to the 2007 September. Even in 2007 September Bees book, they said like 7 districts out of 12 are flat or declining, with the softer home sales and consumer spending is contracting. I see similar kind of wording, so I'd like to share that point here. And I'm saying first warning signs. And this is the employment situation. So it's saying that unemployment rate is 4.2, but it is going up from the 3.8, which is not a good sign. And also the non-farm payroll employment came better than the expected, better than the last month, but this is not a good number. And household survey data, both the unemployment rate and number of unemployed increased from the previous data from 6.3 to 7.1, and also 3.8 to 4.2. And this unemployment rate, can cause by four ways, like four types of unemployment, like frictional, structural, seasonal, and cyclical. So looks like for me it is cyclical, because unemployment caused by lack of overall demand in the economy, not seasonal. It's not a winter, and it's not a structural issue, and it's not a frictional one. And the JOLTS data, job openings rate seasonally adjusted. So job openings are going down continuously from last more than 1 year, which is not a good sign. And hires and total separation is like layoffs or quits, that kind of thing. Hire is new hires. So they both are also going down, so which is not a good sign. And this job openings, hires, total separation by industry. So the job openings are happening good at the financial activities, but lot of other sectors, their industries, they are going down, especially education, health services, and also the food services. And this is household data, employed persons by class of worker and part-time status. So when they calculated the employment, they calculated everything like full-time jobs, part-time jobs, temporary jobs, seasonal jobs, everything. So I'd like to see how much the part-time jobs increased or decreased in this report. So compared to the last 1 year, from August 2023 to August 2024, part-time jobs are increased with various reasons, especially economic reasons. They mentioned like previously it is 41, 43 people are mentioned, but now it is increased to the 47, 57. So looks like the part-time jobs are increasing a lot in this employment data. And this is business cycle based on the economic cycle, like economic growth, inflation, and unemployment. Business cycle impact. So business cycle is like 11 sectors in the spike. They behave differently, outperform and underperform based on the economic growth, inflation, and unemployment. So in the early economic growth, these sectors perform outperform and these do underperform. In the mid economic growth, these two sectors outperform and these two sectors underperform. I'm thinking right now we are moving from the mid to the late growth. I'll share why I'm saying that. Let's see how the information technology, materials and utilities, because from change from the mid growth to the late growth, information technology outperform to the underperform, and also utilities, materials, they need to underperform to the outperform. So this is the technology 3 month chart. Looks like this candle is very bearish candle. It's like a feather top kind of candle, but the right now MACD is flat, not that much bad, and but RSI is going down, which is not a good sign. And also there is a huge negative divergence in this price action and also the RSI. And this is a monthly chart. So monthly chart, the candle is very bearish candle, MACD is going down and RSI is going down. So this is not a good sign for the bulls, for the technology. So there is a chance from outperform to the underperform in next couple of months. But let's wait for September and October, because September and October are very bearish months. So we should not consider this. Let's wait for till November. And this is utilities. Utilities should underperform to the outperform if they are moving from to the mid to the late growth. So this is a 3 month chart. Last 1 year it is going up with the lower volumes, but the MACD is going up and RSI is going up. So if it breaks this level 75, then the next resistance is 90 level. And this is monthly chart. So right now it's a very resistance level, but the MACD is going up and RSI is going up. So looks like utilities are moving from the underperform to the outperform, which confirms mid to the late growth phase. And this is materials. So materials is a 3 month candle. So this candle is not that good, and the MACD is like a flat pan, which is not a good sign for the bulls, and RSI is going flat. And for the monthly chart, last couple of months it is going sideways. It need to break upside if to perform outperform from the underperform. Let's see how it is going to be. So the technology sector is going down, utility is going up, which are the signs of the phase change from the mid to the late. But we need to wait for the materials how they do and what they do, then we can confirm. And the summary is QQQ looking very weak and trying to find support. September and October are seasonally bearish months. Employment data and beige book are giving early sense of weakness in the economic activity. I showed that beige book data and also the employment data. Looks like sector rotation is taking place as growth peaks. So we saw that business cycle, there is a chance of mid phase to the late phase. Based on the materials, I would like to see next 1 or 2 months how the material sector will do. Then we can confirm. That's all for today. Hope you like this video. If you like this video, please hit the like button. Please watch more videos in my channel. Please subscribe. Please hit the bell icon so that you'll get notification when I upload a new video. Please share this content if you are friend looking similar kind of content. Thank you so much. Bye bye.